Hello friends, welcome to the July edition of Monthly Viewpoints. Post the elections and a strong mandate for the incumbent government, Indian equity markets reached an all-time high at the beginning of June. After that, markets have taken a breather and all eyes were on the Union budget for fiscal year 1920. The budget announced on July 5th ticks all the right boxes as it focuses on policy continuity and sustainable growth while not compromising on fiscal consolidation and macro stability. The policy direction seems to be progressive towards elevating the Indian economy from the current $2.7 trillion GDP to $5 trillion by 2024-25. The emphasis is on investment-led and inclusive growth. Now, we have seen a slowdown in consumption over the past couple of quarters, and apart from the election uncertainty, one of the key reasons was the tightening in the liquidity due to the NBFC crisis. To address this issue, the government has extended a 6-month window of one-time guarantee for first loss up to 10% for purchase of highly rated pooled assets of financially sound NBFCs up to 1 lakh crores. The RBI has also infused additional liquidity of up to 1.5 lakh crores. Cumulatively, both these measures should add liquidity amounting to almost 10% of the NBFC and HFC sector size. The government is also proposing to infuse INR 70,000 crores in the PSU bank recap, which is higher than the market expectations. The housing sector is a big contributor to overall GDP growth, and the government has announced that for purchase of affordable housing up to Rs 45 lakhs, the income tax exemption will be increased from the current 2 lakhs to 3.5 lakhs per year. In phase 2 of the affordable housing scheme, the government is also proposing to construct around 1.94 crore houses with amenities such as electricity, LPG and piped water. This should give a boost to the real estate, housing finance, cement, building materials and consumer goods sectors. The government has announced a slew of measures to attract both FDI and FPI. One of the measures announced is to increase the public shareholding in listed entities from the current 25% to 35%. By increasing the free float, this will increase India's weightage in the MSCI index and other foreign indices, causing FPIs to invest more in India. On the other hand, one of the impacts will be that due to additional supply, this may put pressure on prices. However, this measure is still to be ratified by the SEBI and it may be done over the course of 3 to 4 years. The government is also looking to borrow a part of its gross borrowing program in other countries in external currencies. This will result in lower borrowing domestically, thereby providing space for private corporates to borrow in India, and will also result in lower rates and rate transmission. Regarding the overall fiscal math, the assumptions seem to be well anchored, and the government has stuck to its fiscal deficit target of 3.3%, whereas the market was expecting a slippage to 3.5% or 3.6%. To its credit, the government has not been socialistic and has not resorted to short-term measures to boost consumption. Now, coming to the global front, post the G20 summit meeting last week, President Trump and the Chinese Premier Xi Jinping have agreed not to impose tariffs on each other and resumed their trade talks. The resolution can be expected by the end of the year or so. In the US, the Fed has also indicated that it is more likely to look at reducing interest rates in the face of a slowing economy and low inflation. Consequently, global equities have got a boost. However, last week we saw that the US jobs growth number came out quite strong, thereby raising some questions as to whether the Fed will reduce rates at the next meeting in July. So coming to our view on the markets, we believe that the government initiatives are likely to result in a revival of growth after 6 to 9 months. Given this, we believe that the market will consolidate in the short term. However, we remain constructive on India's economic growth given the range of reforms and policies that the government has outlined. Hence, we believe that investors should continue to build equity exposure for the medium to long term, especially by investing in SIPs. Select themes that we are participating in include consumption, which includes the consumer and consumer discretionary sectors, financials, which includes the private banks, corporate banks and select NBFCs, and industrials, which includes capital goods, infrastructure and cement. We provide a basket of suitable funds for investors to choose from. Thank you and happy investing.